Yield curve hitting a record this week. What does this mean for your investments? Also, stocks up for the 5th day. Many on Wall Street are buzzing about the Santa Claus rally. Is this the little market that could and will continue to? Because it already has. Let's ask Tom Lydon, editor of ETF Trends.com, and Jim LeCamp, portfolio manager at Macro Portfolio Advisors. Tom, how early did you get in, and how long did you stay at the party of this 65% move?
We got in late April. Joe, basically when you go above the 200-day average in the S&P 500, that's a great general indicator for investors. And again, during an emotional time, they need a little bit of guidance. So again, just following that simple rule, you can't fight the trend no matter what the economic conditions say. And again, it helps from a discipline standpoint as long as you're just keeping an eye on that trend.
Jim, it was hard to get long in March or April, and I've seen some people even have more trouble staying long through July, through the doldrums. You're bearish now. Were you ever bullish through the 65%?
Well, early on in the year, we bought corporate bonds and high yields. We thought they were very attractive and better values than the U.S. stock market. Then we started buying the emerging markets in about the same time, late April, May. So we weren't real bullish on the U.S. market. And in fact, we still felt like the emerging markets offered better opportunities. So we made a bigger play there. Fortunately, they made a bigger move than the U.S. market. As good as our market has been, Joe, it hasn't been as good as the markets around the world. Now, a lot of that has to do with the weak dollar, but a lot of it has to do with growth and the demographics of these markets. So we're still bullish in the short term, but we're bearish longer term because of the headwinds facing the U.S. economy. The banking sector is still very much in trouble. The assets are still deteriorating. Lending is down. And small business owners that represent 84% of jobs in America and 60% of new jobs, small business owners are more uncertain than ever before, and this health care package isn't going to help.
So, Jim, you're in that camp that says ultimately the consumer's not really coming back and still 70% of GDP is the consumer, and therefore we're not going to rebound.
Yeah, I don't know where they're going to get the money. The jobs are down. Consumer debt is still way too high. They're going through deleveraging. I don't know where they're going to get the money to spend from their economic nether regions, I guess. But if you don't have jobs, and I don't see jobs returning anytime soon, maybe you're seeing an increase in temporary jobs, but that also speaks to the uncertainty that small business owners have. They're taking on temporary jobs more so than permanent jobs because they're unclear about what taxes are going to be or health care.
Tom, meanwhile, you say don't fight the trend. How far does this recovery have to go?
Well, I have to agree with Jim. We've had some great moves overseas, and again, with ETFs, there's so many different choices, and you can pick your spots. You guys talking earlier about technology. We've got earnings season just a couple weeks away, and we're probably, again, going to see better than expected numbers. So for the average investor who still doesn't believe in this market, as we get into next year, as we leave this decade of flatness behind, I think for the average investor, if you pick your right spots, and yes, global markets, technology, areas like companies still have a bit of a run ahead of us.
All right,
and Joe and David,
yeah.
I just want to point out that investors need to be careful about trying to outguess a liquidity-driven market. Interest rates are at 0%, so investors don't have a lot of options here. The last liquidity-driven market we had was 1999. It went a lot farther than most people had expected.
Right.
The payoff was pain in 2000 to 2003, but they can go a long way.
Yep.
Yeah, but
we typically do.
Yeah, but we're still not above where we were 11 years ago this time, Jim.
Exactly.
So it's a little bit different. Anyway, appreciate it, guys. See you later.
Thanks, guys. Merry Christmas.
Merry Christmas. Happy holidays.
Happy holidays.
All right, when we come back.